Hey everybody. I want to talk about how to invest in AI and make money doing it. So as a tech journalist, I occasionally get asked for stock tips. After all, I've been writing about enterprise technology for 20 years. I talk to a lot of vendors. I talk to companies buying all this technology and using it. I should have some insights. Plus, I used to cover the securities industry, Wall Street, and I've got a degree in math, and I've covered like tons of business and economics and all that stuff. So I should be perfectly positioned to tell you how to invest in AI and make money. And I am. I have a foolproof investment strategy, and nobody's gonna like it. It's kind of boring. It works, and you're gonna make money. You're gonna make more money than professional investors, but it's kind of boring. So, so the problem with investing in general is that A, the house always wins, and B, we humans are emotional animals. We make our decisions based on emotions and then retroactively try to find facts to justify them. And we don't even notice that we're doing it. And also, we have very weird kind of memory where we remember only things that supports our point of view. So when you gamble a lot, whether it's in a stock market or in a casino or in a sports betting app, whatever, you tend to remember your wins and forget your losses. You tend to ignore your costs, the amount of money that the house takes. And you tend to make the same bets as everyone else because we are herd animals. If everybody starts screaming and running, we will also start screaming and running because those of us who didn't and stuck around say, oh, why is everyone screaming and running? Why don't I like take a stock of the situation? Those people got eaten by tigers. There's a benefit to if everyone's screaming and running, you also start screaming and running. And then you find out what everyone's running from. All right? You scream to let other people know that there's a threat, and you run because other people have told you that there's a threat, right? Or if, say something good happens and everyone's running in that direction. You want to join them because if you're late, you're going to miss out on that tasty deer carcass or whatever people found, right? So it's to our evolutionary advantage to be very responsive to the herd. It is built into us. Even if you're a contrarian investor, you're part of the contrarian herd. It is very, very difficult to overcome this. And since we make our decisions emotionally and then justify them later, we don't even understand that we're doing this. It like our decisions make total logical sense to us. And the more money we spend, the more time we spend, the more research we do, the more money we lose. Um, that's one of the like dirty secrets of the financial services industry is, and one of the reasons why I don't write for some magazines anymore is that the pay is really, really good. But I noticed like so so there was a magazine that I wrote for that no longer exists, where the readers were wealth managers, and it paid me 3 times as much as other publications were paying me at the time. I mean, they were paying more than like publications pay today. They were very, very well paid. And I was asked to do a story on sector investing. When you invest in sectors, like the energy sector has some positive indications for next year, and this sector, is in a worse position. So if you adjust your portfolio so it's more aligned with these things, you're going to make slightly more money, right? So these researchers did an analysis of sector investing and proved that you can make money with it. Um, Now, first of all, mathematically, Stock markets are weird, crazy things, and random things happen all the time. So past performance is never a guarantee of future results. I mean, the two have pretty much no relationship, right? Because crazy stuff happens. Um, and then the other thing that was problematic about this research is that it did not take account overhead and fees. Nobody takes those into account. When you take them into account, this was a losing strategy. Because the thing about this strategy, as in many, many strategies Wall Street advisors tend to push on their clients, is that it requires moving money around. Whenever you move money around, you pay a fee. It's not always obvious. Sometimes it's a hidden fee, but that's how they make their money from you. They get you to move money around. And so many investment strategies involve you moving money from one set of stocks or one set of funds into a different one. And anytime you do that, you're gonna take a little hit, and those hits add up. Another thing that was a common strategy and still is when you have a bunch of mutual funds. Any given year, roughly half of them are going to do better, and roughly half of them are going to do worse, plus or minus. Not even considering like the overhead and the fees and the huge salaries you're paying to the fund manager. Um, And so what these groups would do is that when a fund's doing really, really well, they promote this fund heavily. Oh, look how well our fund did. And then in tiny print it says, past performance is no guarantee of future results, right? To kind of like cover themselves, right? And what people would do is they would move the money out of the worst performing funds into the highest performing funds. And they would keep them in the same family because otherwise people would leave that whole mutual fund company and go to a different mutual fund company. So they keep them in the same family and they move them around between funds. And every time you move around between funds, you're selling the fund that did badly that is now cheap. You're buying the fund that did well that is now expensive. You are selling low and buying high, which is the opposite of what you should be doing. And in general, anytime you make an investment and you move a money from an underperforming investment to one that you think is gonna do well, you're selling low and buying high, opposite of what you should be doing. And then, of course, anytime you make a move, you're going to lose money. This is why more than 90%, I think the last time I looked at the numbers, it was close to 97% of day traders lost money. The only people who made money day trading were the companies selling day trading software. And day trading software is horoscopes. It's like, oh, look at that pattern of stars. It looks like a bull in the sky. That is literally how, like, all the statistical analytic type of stuff works. It looks for patterns in the graphs and says, oh, it looks like this. This is what you should do when the moon is rising in Jupiter. Yeah, you're going to lose money when you do this. You're going to lose money when you do this. And if you're a rich person losing money when you do this, I don't care. But if you're like a middle class person losing money when you do this, that kind of does bother me, because you're losing money. So, how do you make money? Guaranteed strategy. You make money in the stock market and you make money on AI in the stock market because AI over time increases productivity, which means it helps grow the economy. Everybody makes a little bit more goods and services than they produced before, which is a definition of economic growth. So if you invest in the economy as a whole, you're investing in economic growth. And the engine of that economic growth today is AI. That's how you benefit from AI in your portfolio. That's one thing. Invest in the market and the economy as a whole. How do you do that? You invest in a low-cost index fund. This is a fund where you buy, I'm simplifying here, one of each stock on the planet or one of each stock in the country, right? The broader base, the better. You're investing in the whole economy. You want a no-load index fund. This is a fund that is minimal overhead. And then you keep your money there. You do not move it around. You don't look at it, all right? So that's how you bet on the whole economic growth and on the potential of AI. Then here's the part where you beat the stock market. Because if you just invest in the market as a whole, you're going to do just as well as the stock market. Now, you're already going to do better than most professional advisors just by doing that, right? Um, so just by doing that, you're ahead of like pretty much everybody, right? Who are all like monkeys throwing darts at dartboard. So you're already ahead. But now here's the trick that will take it one step further. It's called dollar cost averaging, or in other terms, pay yourself first, or in other terms, put the same amount in every single month in automatic deposit. So for example, if you get a broad-based Vanguard fund, every month you can put $100 in it or $1,000 in it, whatever you can afford. Take it right out of your paycheck before it hits your checking account. So you don't even see it, right? The money's gone. It's not like, titillating you, saying, "Oh, spend me, spend me, spend me." You put it right into your brokerage account. And the dollar cost averaging is this really cool trick because when the stock market is low and the stocks become cheap, you wind up buying more stock for the same amount of money. And when the stock market is high and the stocks are expensive, you wind up buying fewer of these overpriced stocks. So you're buying more when it's cheap and less when it's expensive. This is exactly the strategy that we should be pursuing, but none of us are when we're active investors. The more active you are, the more you read the financial papers, the more you follow individual companies, the more money you will lose. The more money you put away every month in a no-load index fund, the more money you're going to make. For really an extra dollop of income, put it in a tax-deferred fund like a IRA, and you might want to talk to an advisor about how to specifically, which one's best for you, based on your income and whether you own your own business or an employee, or there's nuances. But if you can, put it in a tax-deferred account, and if you can, max out your contribution. That money is now going to grow at the fastest mathematically possible rate. And once you've maxed those out and you still have a little bit of money left over that you can put into your savings, put into like a regular brokerage account. And you're not getting the tax deferments, the tax advantages, but you're still getting the growth. So that's how you do it. If you have an advisor who gets paid by the hour, this is what they will recommend to you. If you have an advisor who gets paid on commission, that is not what they're going to recommend to you. You don't need an advisor to set up automatic deposit into a Vanguard fund. I did it. It took me like about 10 minutes. This is really, really, really easy. The hard part is deciding, do you want to invest in all the American stocks or all the global stocks? How diversified do you want to be? That's literally the biggest decision you should be making. Make it once and then leave it alone. Do not touch it. Do not second guess it. Just leave it alone to do its thing. Don't check the app. Don't look at it, nothing. All the stuff about, oh, this company's doing really well, Nvidia stock is up. This exactly the same stuff that you get in those ads for online sports betting. Oh, you have a hunch about how your team is going to do. Quick, put money on your hunch. That is stupid. It is absolutely stupid. Warren Buffett said dollar cost averaging in an index fund, and he knew what he was talking about. Now, there is one other way to make money investing. And this is what people like Warren Buffett do. And this is where you buy a controlling share of stock in a company that's doing badly. You pick a company that's doing badly. You fire all the idiots and you bring in a bunch of smart people. You have to, first of all, know what a good company looks like and what a bad company looks like, and you know what those foundations are, the fundamentals are. You have to be able to tell smart executives from dumb executives. It's really hard to tell. Some of those dumb executives are really good at BS. You have to have the willpower to fire them and put in a decent team and turn a company around. And you often have to have deep expertise in that industry sector or have a good team behind you of people with deep expertise in that industry sector. If you don't have those things, and I venture to say most of us don't, dollar cost averaging, the broadest based index fund you're comfortable investing in. Put in as much money as you can every month and put as much as you can into a tax deferred savings account, a tax deferred investment account. There you go. Good luck. Enjoy your money.